David Baker. He's managing partner at Baker Steel Capital Managers. David, thank you very much indeed for joining us. Well, we've seen gold under a bit of pressure. Does that continue?
I think that potentially the support down there at around 1537, which is around the 200-day moving average. You know, we tested that last week. It bounced quickly off that. I mean, we'll see. We could see a bit more weakness, but the physical demand has started to, starting to soak up the supply. So, I think the downside is limited.
Yeah, of course, we've got Golden Week in China. We've also got the Indian marriage or the wedding season upon us. That's likely to increase the physical side of it all. So, you know, do we get up and close to the record highs that we've had in recent months?
Well, I think towards the end of the year, we certainly see firmer prices. Whether we break those prices and get to 2,000, we'll see. But I think we're forecasting higher prices. I think there's every reason to believe that in the market.
Right, David. Well, how do you actually do this? Do you actually buy bullion itself, and do you also then buy some of the equities which are associated with gold?
We're invested in mainly the equities at the moment, so we're generally buying mining companies that mine gold. And at the moment, that really is a story, because the gold shares are discounting probably $1,100, $1,200 an ounce. So, particularly over this year, they've been derated very much by the market. Gold's at 14% this year, and the gold equities are around 10%. And we see part of the reason for that. Barrick bid for Equinox around April of this year, and from around April to today, we've seen this disconnect. Now, earlier this week, we saw that the Qatar investment bank has signalled that it's going to invest about 1.3 billion into European gold fields and potentially 10 billion into the sector. So the disconnect in the market between the equities and the physical is getting to some kind of extreme, and it seems like a cheap way to buy physical by buying by the equities.
I guess also you've got many of these companies which were given that spread that you're talking about, that divide, and many of them are incredibly cash rich and are returning money to shareholders.
Well, we are seeing increased dividends. That's a key. But, we saw earlier last week, I think it was, that Resolute Mining in Australia announced that it was going to implement a 10% share buyback of its capital. So the balance sheets of these companies are good. The earnings, we think, are going to be fantastic when the reporting season starts in the next couple of weeks. And so we see every reason that these gold shares will actually catch up. We've got the underpinning, as I said, from the sovereign wealth funds now, and they're cheap.
Right. Well, you're not such a fan of silver, are you?
See, I think, if you're going into a double dip, silver's more of an industrial commodity. Physical demand's quite good at the moment, but, we see there's less momentum in that market at the moment. And, our view is that the gold shares are cheaper than the silver shares. So, we're focusing more on the gold shares rather than the silver at the moment.
David, thank you so much for joining us. David Baker there from Baker Steel. David managing the Genus Dynamic Gold Fund.